presentation contains current opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak Asset Management YouTube update for November 12th, 2021. I'm Mo Ansari, President of Compak Asset Management and host of Market Wrap. You can tune into a daily broadcast that I do every single weekday. Or you can tune in, find out what I'm thinking, what I'm doing. Great guest. Today we had a great guest. Avi Gilbert joined us today, and it was a great broadcast. He is one of the people that teaches Elliott wave analysis. I know you hear me talk about the waves, and some of you call me and say, Mo, I know you're in Newport Beach, so maybe you're riding the waves. No, I don't surf, folks. That is Elliott wave analysis, and it was a great guest. But you can get that every single day. Simply go to the Apple Store and download the Apple app. It's free. All you have to do is go type in Market Wrap with Mo, and you can get the app down there, or you can just go to the Google Store. I will be in Scottsdale next week, so if you want to come and meet with me, I will be there on the 16th and 17th of next week. That is Tuesday and Wednesday of next week. I will be there. If you want to come and meet with me, I will be there. We can sit down, talk about what you're doing, how your year went, what are you looking for in 2022, and how do we set a roadmap to get you from where you are now to where you want to go financially. On the 7th, I'm going to be in San Jose. That is a seminar. I will be there in person, but we have very limited seating because of COVID. We've got to do the social distancing and all of that, so very limited seating. I will be there on the 7th. It's a lunch, and you can learn what we do here at Compak. You can get all the results, find out what we do. You can look at what we've done this year, what we've done over the years. How do we really develop that plan? That is on December the 7th, next month. It's a few days away, but again, as I said, limited capacity, so go to compak.com and register there. Let's go into the numbers. Pandemic is still out there, but not really. I think we're putting pandemic behind us. That's the way it is now. COVID is behind us. We've got our booster shots, but we are starting to see, and the U.S. has ended the 19-month pandemic-related border restrictions where people now can come into the United States if you're vaccinated of a PCR test. If you look at the effective reproduction numbers, it is way down in the states with blue. Those are the ones that have some of the highest vaccinations. Average number will become infected by in time. So if the RT is above 1, cases will increase. If it's below 1, it is decreasing. So most of the states, except a few, those are good. But there is an orange one right here and one right here that has a little bit of an infection rate there. We have the mandatory employment vaccine requirements coming up. We had a poll and found out 37% of the people said, look, if I have to get vaccinated, if they're still not vaccinated, they will leave their jobs. 11% said they would get vaccinated. 46% would opt for weekly testing. They said, okay, I'll keep my job, but I'll get. These are the people unvaccinated. If no testing option was provided for that 46%, 72% would leave their job. So people who are not vaccinated now believe that that is the best thing for them at this point. But those numbers are getting smaller and smaller. You look at the recovery tracker, initial jobless claims in 2019 were 222, 267, very close to that. Continuing job loss claims, we're at 1.7 million now, we're at 2.16 million. So we're close, getting very close to the pre-pandemic highs that we were seeing. Weekly retail sales, you can see they're at 5%, we are higher now. You're looking at box office coming back, rail car traffic very close to where it was, steel production. We're just about back to where we were pre-COVID as far as all the numbers are going. TSA checks are the only ones that are really down about 20% still. That I think is due to international travel. But now that international travel has opened up, I think we're going to see those numbers, and that is global commercial flights, you can see, are still down 20%. That will pick up too. Help wanted. People are quitting at a record number. So the shortage we have in people in labor is definitely getting worse. People are quitting their jobs at a record number, and we're seeing this as the job openings. It is at an all-time high that we've seen in the last 20 years. So there are more jobs available, just people who are saying, look, you've got to pay me more. And that brings us back to that inflation number at 6.2%, the highest number we saw in 31 years. We've heard from the Fed, and I was believing that the inflation is transitory, but it's now getting to be a point. Fed wants 2% inflation. We're at 6% now. I think sooner or later the Fed will have to tap on the brakes. The question is when. I don't think they do anything in the next month or two. Get past Christmas. We're waiting for the renomination of the Federal Reserve Chair. Jerome Powell wants to get renominated, or if we get a new chair, it'll take a while for them to sort of get their feet on the ground and figure out what he or she is doing. So we might be 2 or 3 months away, but if we keep getting these inflation numbers at the levels we're at, I think the Fed might have to tighten the tap a little bit more on tapering. They've decided that they're going to do $15 billion, cut back on their bond buying program by $15 billion. From 120, they're going to reduce it at $15 billion per month. That still puts about $500 billion into the economy that they'll put in before the tapering ends. That's before they raise interest rates. Will they speed that up a little bit more? They could do that, and that could cause some anxiety in the market. Right now, the market thinks that the interest rates will be going up somewhere in the middle of next year, that we'll see the first interest rate increase. Their expectation is that we'll get 2 interest rate increases middle of next year and between the middle and the end of next year. But that all depends on how inflation goes, what happens to the global economy, what happens to growth in the United States. So there's a lot of variables between here and there. We did get a little bit of pullback. I talked about that on the radio broadcast at the beginning of the week. I said if we get 1 to 2%, it'll be good. It'll just refresh. It'll be the pause that refreshes the market. That's what we saw this week. We were off slightly for the week. In most of the indices were down. The Russell was down the most, down about 1% for the week. So you're looking at, but the stocks did snap the weekly winning streak that we had, that we were down this week, and it is the first week. The Biden reconciliation plan is still somewhere in Congress. I don't know how much of this goes through. They passed the infrastructure bill. That takes the pressure off the moderates to compromise, and the progressives held firm, but we had some Republicans join the Democrats to pass the hard infrastructure bill. That took the pressure off now the moderates to compromise, and it might be that they are going to ask for a lot more cutbacks. Most of the tax increases that we were worried about, capital gains taxes out the window now. We're not seeing any talk about raising the stepped up basis. There are some corporate taxes, some minimum taxes, but those are minimal that we're hearing. So this is what is coming out of the clean energy is about $555 billion. Childcare is about $400 billion. Home care 150, housing 150, ACA to give some more money for health care, about 130, equity and other investments 90, immigration bill 100 billion. I don't know if this is going to be allowed in the reconciliation bill. Child earned credit, they want to extend that everybody gets that, and then higher education and workforce, that's 40 billion. This is where I think we need to put more money. We need to give our labor force the skill set to compete in this global economy. Looking at the charts, we had this little pullback this week. If we can get above this 47.18 high that we made last week, that would clear the way for my fifth wave target, and that comes in at 48.80. We closed today at 46.80. That's 200 points higher than where we are now. On the pullback, this is a little bit, if we can't get above 4,700, we're there and we turn back down again, then we could come down somewhere around here, which is around 40. This is the low that we made, 4,300, 4,400, 4,480 or so, somewhere around there. That would be ideal if we see that another pullback. But if we don't see that break out to the upside, then probably we might even get to 48.80 by the end of this year. That would be a very nice run in the market. Support also at the 50-day moving average, 44.92, and then the 200-day moving average, which is 42.52. This is the weekly chart. We're still in the third wave. That's where we are right now. somewhere we are going to get a fourth wave pullback. And that fourth wave takes it to about 4,200. Will we get that from 4,800 back down to 4,200? That could happen. If we get past 4,800, 4,900, and we get the fifth wave top on the daily charts, then we can set for the first quarter to be pretty dicey, as the Fed might have to tighten a little bit. That'll scare the market, give us about a 10% correction. I still view that as a buying opportunity, because if we do get that pullback on the downside here, then we clear it to the upside afterwards. And I'll give those targets to you in the next week if we see that somewhere down the road. Well, if we see first we got to make new highs, then we got to get the pullback, then we'll look at the targets first. So we will see that. That's the way I'm looking at the markets for the next 6 weeks or so. It looks like we are going to go and visit Santa Claus. It just depends if you've been naughty or nice, if you've got coal in your socks, or you've got some more green on the screen when you visit your account. That will depend. I think if you've been invested properly, you've got the allocation correct, you will come out okay on that. Looking at the Nasdaq, 16.2, if we can get above the 16,000 number, that's the high that we made. We came back. This was my first support at 15.6. We got there this week. This could be the fourth wave, and then we start, this is wave 3, could see wave 4. If we get above here, then we clear it to about 16.6 on the daily charts. Each one of these lines that you see, vertical lines, green and red, is 1 day of trading. That's it goes back to the beginning of this year, and we started right about 12,000 for the year. Looking at the weekly charts, 16,450 is the weekly target. Long-term target is 20,000 for the Nasdaq. But do we go first to 16, then come back and make a fourth wave pullback and then a fifth wave? This is long-term, probably 1 year out or a year and a half out, somewhere around there. First we go up and then we come down before we start. But the support now is 14.8 and 13.8. Those are the two numbers I'm looking at. Gold had a good week today with the inflation numbers coming out at a 31-year high. It pushed the gold market above the 200-day. Finally, we had this triple top right here, about 1835, 1840, and we broke out above it this week around this 1840 resistance. Now we closed today at 1867. Any pullbacks down to 1840 will be a fourth wave, and then we get a fifth wave rally to the upside. Support 1792, which is the 200-day moving average, and 1785, this 50-day, which is the blue line. When it crosses above the 200-day, that is called the golden cross. But we did get, and this, when it crosses, we had the golden cross here where the 50-day got above the 200-day, but it only lasted for a period of time. And then we get what is called the death cross when it breaks below it, and that's where we saw the market come down. If we do get above 1792, and this moving average crosses, which it might next week, I think that would be a good sign for gold. Inflation is there. I know the Fed is not going to do anything between now and Christmas, so we should see a continued rally in the gold market. But once we get the Fed, if they start to tighten, that'll push the dollar higher. When the dollar goes up and interest rates go up, that puts a negative pressure on the gold market. Small caps, this was the big range that I talked about all year of 2360. Finally, we broke out above it. We'd been in this range for the whole year. Back and forth we went all year long. Finally, we broke out above it here at the beginning of this month, and now we are getting a little bit of pullback. Long-term target 2620. We closed at 2411 today, so that's another 200 points, or about another 7-8% move to the upside in the small caps. Small caps, when they broke out, to me, that, as I've been saying, that is where all the people were. When people put COVID behind us, we start going to restaurants and all the small businesses. That's a small business indicator, and this is the small cap index, and it is breaking out. So I think finally we're starting to put COVID behind us. And looking at the 10-year interest rates, looks like we went up here, came back down, tested the 200-day moving average, which is this magenta line right here, got below it on Wednesday, then came right back up again. I still think 1.79 or 1.8 is my target, or 1.85. We could even get to that. We are 1.58 today on the 10-year note. As interest rates go up, that could put some more negative pressure on the market. That's my views. Those are my opinions. That's the way I'm looking at the markets today on November, but I will be next week. That's today's November 12th. I will be there November 16th and 17th in Scottsdale. If you want to come by, I will meet with you personally. We will develop a plan for you, show you how to get from where you are now to where you want to go. Take a look at our verified track records, what we do, how we do it. Look at our satisfaction guarantee. We do all the service for you for a year. If you're not happy, we give our fees back to you. Then I will be in December 7th in San Jose. Go to compak.com, the website, compak.com, and you can make a reservation. The appointments are free, and so is the seminar. It is free. Lunch is on me. Come and spend some time before you spend any money. Those are my views. Don't forget to subscribe. Whenever I put an update up, you will be notified, so you can come and watch it at your convenience. Thank you for joining me today. I'm Mo Ansari, President of Compak Asset Management. Hope to see you at the next YouTube update.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.